Good afternoon, everyone, and welcome to the second of our Insight series on the Nigerian tax reforms. My name is Chijioke Webute, and I'm the Tax and Regulatory Services Leader for PwC Nigeria. It's really exciting time for us in the tax space in Nigeria because we're undergoing what I'd consider the first real tax reform in the country since independence. And I'd say this is really a step in the right direction and it's really transformational. What PwC has done, just to also help our clients and engage with our clients is to have a series of webinars, which is essentially to help us, engage with you and help you navigate the changes in the tax laws and also how it impacts your business. Today, we will be our focus will be on non-residents and, how the changes in the laws affect the interactions of non-residents and their operations in Nigeria. We'll be handing over to my colleagues who will be running the sessions. One of them is Emeka Chime, who is a director, and the other is Seun Adu, but I'll allow Emeka to do the proper introductions and walk us through the sessions. So thank you very much for your time, and I look forward to a really engaging and interactive session. Over to you, Emeka.
Thank you, Chijioke, for that wonderful introduction. So I'll go straight into also introducing our presenter for today. Chijioke introduced me, so I don't think there's any need to introduce myself further. But I'll just say I'm a tax director here with PwC, and welcome again, everyone. So this session will be facilitated and run by Seun Adu. Seun leads the transfer pricing team here in PwC Nigeria. He's a partner with more than 20 years of tax and transfer pricing experience. He has been involved in providing transfer pricing services to several PwC clients, ranging from oil and gas industry, shipping, technology, digital marketing, financial services, power, FMCG, you name it. Seun has led various transfer pricing and international tax services work around due diligence, transfer pricing audits, tax investigations, and the likes. He was a member of Nigeria's National BEPS Implementation Committee, set up to examine the outcome of the OECD's BEPS project, and advised the Federal Ministry of Finance on the proposed changes to Nigerian tax laws. He is a key transfer pricing resource person for ICANN and has facilitated numerous workshops and training sessions on international tax services and transfer pricing. That being said, I'll quickly hand over to Seun for what promises to be a very insightful session on the impact of the new tax laws on non-resident companies, including foreign shipping companies, as they navigate the business terrain with Nigerian customers. Over to you, Seun, and thank you once again.
All right, good afternoon, everyone. Thank you for joining us for today's session. Just like Chijioke has mentioned, there are many significant changes that are coming through with the new Tax Act. And today, our focus will be on discussing those changes that have particular relevance for non-residents. And we'll essentially be having conversations around your typical non-residents that have foreign headquarters, as well as locally led non-resident companies. The agenda for today is to first talk about the tax reforms in general. We'll do that very briefly. Then we will move into talking about what has changed for non-residents. And finally, we'll discuss some of the things that we believe you should be doing to ensure that you're ready when the acts come into force next year. Just broadly speaking, by now, many of us are aware that the president signed the act into law on 26 June. And the feelers at the moment are that the various acts will come into force by 1st January 2026. From a top-level perspective, the ideas behind the acts are to consolidate the existing tax laws and also close certain gaps or loopholes in the existing tax system. It's also to harmonize tax administration in general and see how we can digitize the tax processes and administration for Nigeria. And I would say from the perspective of how the Act interacts with non-residents, there's quite a bit in terms of changes that would close out what you'd consider certain loopholes that existed in the past. But we'll be looking at those in detail. The framework for the 4 different acts that have been the topic of discussion for the most recent past is essentially, first, there's the Nigerian Tax Act that tries to outline what taxes would be collected and essentially consolidates a number of tax legislation. We then have the Nigeria Tax Administration Act that outlines how the taxes would be collected. We also have the Nigeria Revenue Service Establishment Act, which essentially tries to give a new face to what we currently know as the Federal Inland Revenue Service. And finally, there's the Joint Revenue Board Establishment Act that looks at how different revenue services can work together and collaborate and support each other. It also has provisions around tax appeals, essentially. So if we go straight to the meat of today's conversation, what will change for non-residents? There are a couple of points we'll cover. You'd appreciate that we can't cover everything that has changed in 30 minutes. So what we've tried to do is to pull out what we consider to be some of the most significant changes, as well as those changes that have far-reaching implications. So we'll start by looking at the definition of non-resident. And when we were looking at this and discussing this in-house, what we started to see was that there are several companies that, under the current legislation, they would consider themselves to be non-residents. But in actual fact, when the new act gets into force, they will be Nigerian companies for the purpose of tax. And that's really a major shift. We'd also look at what non-residents will be taxed. So after going through who will be considered non-residents, we look at the nature of profits that will be taxed. We'd also zero into the new rules around permanent establishments. So there's been an extension of the meaning of permanent establishments based on the new acts. We'd also look at what the acts say about the attribution of profits to permanent establishments and SCPs, including the minimum tax provisions. We would then consider the changes that we have to the taxation of shipping and air transport businesses. We look at a few things that have changed in respect to how double tax treaties will be applied, look at chargeable gains, taxation of controlled foreign companies, and then we look at Nigeria's response to the Pillar 2 conversations. So who is a non-resident? And this sounds quite obvious from the definition, and that's what it actually says. It says any company that is not a Nigerian company. But what this then means is you need to understand who a Nigerian company is before you can figure out who a non-resident company is. And this is where things start to get interesting. What we've had traditionally is a Nigerian company or a person that is resident for tax in Nigeria is a company that is incorporated in Nigeria. And that will change with the acts. So beyond incorporation, the Nigerian Tax Act includes additional conditions through which companies will be considered to be Nigerian companies. The first one is central place of management or control. So what this means is you could be a company that is registered outside of Nigeria, say Mauritius, but if the central place of management or control of that company is in Nigeria, then that company effectively becomes a Nigerian company for tax purposes. So that company will not be seen as a non-resident company. And even though the Act does not define what this means, the general interpretation is it looks at the place where the highest level decision making of the company happens. So you think about the board and where the board sits and the likes. The other condition is effective place of management and control. So you're not incorporated in Nigeria, your board does not sit in Nigeria. The next question you then need to ask is the company effectively being managed and controlled from Nigeria? And this would generally look at where senior members of the company and where day-to-day operational and commercial decisions are made. So think of C-suite level activities and decisions. So if the senior members of the company or persons that control the day-to-day activities of the company are based in Nigeria, then that company, even if it's registered outside of Nigeria, will be deemed to be a Nigerian company and not a non-resident for tax purposes. And the question then is, so what? Why does it really matter if it's a Nigerian company or not? And many of us would know that there's a big difference between how a Nigerian company will be taxed vis-a-vis how a non-resident company will be taxed. A Nigerian company will be taxed on its worldwide income, meaning regardless of where that income has been sourced, it becomes taxable in Nigeria. So if you have a Mauritius company that's based on the central place of management or control is deemed to be a Nigerian company, it means the full profits of that company become taxable in Nigeria, regardless of where those profits have been sourced. Whereas if you have a non-resident, the tax nexus in Nigeria is only in relation to the profits that are sourced in Nigeria. And this is quite significant, particularly for Nigerian-led groups or Nigerian headquartered groups that have entities registered outside of Nigeria performing different functions, where for those companies or groups, the people making the key decisions are based in Nigeria. Those entities, regardless of the place of registration, could effectively become Nigerian companies and taxable on their full profits, regardless of the source. So what we've established what's in a resident company or Nigerian company is, we can deduce what a non-resident is. The next question is, what profits of the non-residents are liable to tax under the Act? The Act introduces the permanent establishment concept and defines this concept. Some of the items under this are consistent with what we have under our current legislation, but there are also differences and additions. And we'll go into that a bit more in a few minutes. We also have the significant economic presence, which we already have based on the current law. And this is essentially your digital services, digital activities, and the likes. So that is retained under the Act. However, we have a new category of companies that will be considered to be liable to tax in Nigeria, or more specifically, non-residents that will be considered to be liable to tax in Nigeria. And these are remote service providers and insurance companies. So the way the Act looks at this is, where any company is providing services and receives payments from a Nigerian company for services provided remotely, then that income becomes liable to tax. If it receives payment from a Nigerian company or the permanent establishment in Nigeria of a foreign company, then it becomes liable to tax. With respect to insurers, it looks at risk that has been insured in Nigeria where payment is made by a Nigerian company or the PE of a foreign company in Nigeria. So even though over the last 3-4 years, we've had service providers operating remotely being liable to tax in Nigeria, the key difference here is it does not restrict the tax base to those service providers providing technical management, professional and consultancy services. Rather, it looks at any service provider that meets that meets the condition of having received the payment from Nigeria. Similarly, the taxation of non-resident insurance companies is also something that is quite new. With respect to permanent establishments, there are a number of important things that have changed with regards to that concept, and a number of them are quite different from what you'd find under normal international tax norms. So the first one is the introduction of force of attraction rules, and I'll explain this via an illustration. So what you essentially have is a situation where if a non-resident creates a permanent establishment in Nigeria, any income that the non-resident derives from Nigeria that is derived from activities that are similar to those carried out by the PE would be deemed attributable to the permanent establishment. In addition, if a related party to the non-resident that has a PE carries out similar activities and earns income in Nigeria, even if that related party does not create a permanent establishment, then that income would also be deemed attributable to the permanent establishment of the first company. So in this illustration, ABC Dubai has a PE in Nigeria. The PE is undertaking activities and earning income. There's a separate customer in Nigeria, different from the customer that is being serviced by the PE. ABC Dubai earns income from that other customer based on activities that are similar to what it's doing through the PE, even though its relationship with that customer does not necessarily create a PE in Nigeria. You also then have a third company, a related party, that is also undertaking similar activities for another customer in Nigeria. Those activities do not necessarily have to create a PE, but under the new laws, all of the income earned by these different entities will be deemed attributable to the PE and therefore taxable in Nigeria. And this could have far-reaching consequences for companies that operate in groups, because I've seen situations where there's a member of a group that has a PE in Nigeria. Other members of the group provide services or derive income from Nigeria without necessarily even knowing about the activities of the entity that has a PE. What could then happen as a result of this is everybody then has a permanent establishment, or more like the profits earned by all those other companies are then attracted to the Nigerian PE and liable to tax in Nigeria. So essentially, in this example, instead of $1 million being the taxable income in Nigeria under current law, under the new law, you're looking at taxable income of $4 million. The other important change that has happened to the definition of permanent establishments has to do with projects or turnkey projects more specifically. Under current laws, if you execute a single contract for surveys, deliveries, installations, which we commonly refer to as turnkey projects or EPC contracts, the entire profits from the contract become taxable in Nigeria, which is some deviation from what you find under normal international tax norms, because typically the supply part of the transaction does not happen in Nigeria, would normally not be taxable. However, we've had rules that would try to tax the entire contract if it's a single contract. But the way people have planned around this over time is to split up the contracts. So to avoid that situation where the entire contract becomes taxable, you separate the supply of the goods or equipment from the activity that will happen in Nigeria, and that's where you limit your tax to just what is happening in Nigeria. But the Act tries to work around that and close that loophole. And what you have is a situation where, regardless of the split or place of performance of the different activities, all of these activities become liable to tax in Nigeria. So I'll just quickly illustrate this. So in this example, there's a group that is trying to execute a turnkey project in Nigeria. The Dubai entity supplies equipment to Nigeria. Because somebody has to come down, somebody has to be around to do the installation, you then have a Nigerian entity doing the installation. You could also have some other related party or even a third party providing supervisory activities in relation to the project. What would happen under the current regime if the contracts are separate is only $1 million gets taxed in Nigeria in this example. But with the new acts, you're not looking at tax of $1 million, you're looking at tax of up to $12 million, because the act essentially says, regardless of how you split or who performs what, everything gets taxed in Nigeria. The last major deviation is where the act mandates that when a non-resident provides services to Nigeria through a subcontractor, then that non-resident is deemed to have a permanent establishment in Nigeria. In this example, you have a US customer providing or entering a contract with a service provider in the US. Perhaps they are both headquartered companies. You then have the company that receives the contract subcontracting
Everyone, sincere apologies for the break in transmission. Just some slight technical issues with power on the device being presented from. That is being resolved and we should all be reconnected shortly. Thank you. If you're just joining us, we are still on our Insight series for non-residents in terms of the newly signed tax reform acts in Nigeria and how they impact you if you are a non-resident company that's dealing with customers in Nigeria. Just by way of recap, we've spoken to some of the new rules and how they significantly change who is considered to be a non-resident company and how their profits are taxed in Nigeria. Seun gave us a rundown of these rules, including the fact that a Nigerian company now includes companies with effective place of management and control in Nigeria. So it's no longer based on incorporation. You can be incorporated outside Nigeria, or if you have your management and control in Nigeria, you can be deemed to be a Nigerian company, thereby exposing your worldwide profits to tax in Nigeria. He also spoke to the newly introduced force of attraction rules and the fact that EPC contracts can now expose even transactions and services and procurement activities carried out outside Nigeria to tax in Nigeria. I think Seun is back on and he will just proceed from where we stopped. But maybe just by way of an update, the next point that we were about to look at is the fact that with regards services provided from outside Nigeria, we already know that these services are subject to tax in Nigeria historically if they are technical, professional, management or consultancy services or digital services. The way the new rules have been worded, they don't have to be technical, professional, management or consultancy. Just plain services provided from outside Nigeria are now exposed to tax in Nigeria. And then the other point he raised was around insurance. Previously, there's been that uncertainty with regards to the taxation of insurance companies, foreign insurance companies, from a Nigeria perspective. The new rules now clarify that if you're a foreign insurance business with risks in Nigeria that you underwrite, then you are exposed to taxes in Nigeria. I should say the fact that it also covers or it mentions risks. It means that even reinsurance businesses, that underwrite at the second level, those risks are also exposed to potential taxes in Nigeria when you look at the location of the risks themselves. So that kind of summarizes, the conversation so far. And Seun will be taking this up to proceed from where he stopped. Thank you.
Hi, everyone. Very good. Okay. Apologies for that breaking the transmission, and thanks, Emeka, for running the in-between. So I was just saying that one of the other things that have been added to the scope of permanent establishment is the fact that if a non-resident delivers services in Nigeria through a subcontractor, then is deemed to have a permanent establishment and is therefore taxable in Nigeria. So in this example, you'd see that XYZ Nigeria has been subcontracted to deliver the services that were commissioned by customer US. Ordinarily, under the current regime, you're looking to tax $7 million. But under the new regime, XYZ US then gets pulled into the Nigerian tax net and is then liable to tax in Nigeria. So we've touched on some of the things that have been added to the definition of permanent establishments. The next thing usually, because first, after establishing that a company has a permanent establishment or SEP, the next question is what portion of the profits of that company should be taxed in a particular country? And that's a question that profit attribution tries to answer. And this has always been a bit of a challenge for a Nigerian perspective, even though our laws consider the concept of profit attribution, there are no clear specific rules. That hasn't changed much. There are a few things that the new act refers to in relation to profit attribution, But taken as a whole, there's still some gaps in trying to form a complete picture of how profits should be attributed. However, one of the things that is very clear is the minimum tax provisions for permanent establishments and companies with significant economic presence in Nigeria. The first minimum tax provision is the rule that requires that the taxable profits of a PE or SEP should not be lower than the EBIT percentage of the entity itself. EBIT being earnings before interest and tax. And what I mean by that is this. You could have a non-resident with operations in Nigeria. It's created a PE in Nigeria. It also then has another PE in, say, Guyana. It could be that based on the contracts and commercial environment, the Nigerian PE is not making profits, but the Guyana PE is making a lot of profits. Now, what this law looks at is we don't really care what your Nigerian profits are. As far as we are concerned, we want to look at the profitability of you as an entity. And it is that profitability ratio that we use to determine the profits that should be taxed in Nigeria. So on one hand, it's a relatively simple approach and can remove a lot of the headaches you have with profit attribution. But then again, there's also the question of whether that approach actually reflects the actual activity in Nigeria, because you're looking to blend the profits of the entity and use that to establish what should be taxable in Nigeria. The other thing you'd also notice here is the profitability ratio being used is the EBIT ratio. So this is your earnings before you consider interest. And this could be very critical for a lot of the companies that actually create permanent establishments in Nigeria. Because many of those companies, when you look at the oil and gas sector, for example, many of those companies are asset-intensive operations. They undertake asset-intensive operations that usually require them to finance those assets. So you would always find that they are leveraged because that is a reality and requirement of their business. Now, this rule technically does not accommodate that interest deduction when trying to estimate the minimum tax from a Nigerian perspective. The other rule you also find is that the minimum tax would not exceed the withholding tax. So if you have a PE that has been subject to withholding tax at 5%, for example, it might be that the actual tax on the profits are less than the tax that has been withheld. Under the current rules, you have the option to carry forward the excess of withholding tax. And if things are really that bad, you have the option to actually try to obtain a refund of that withholding tax. With the new rules, that doesn't happen anymore because that withholding tax then becomes your minimum tax and there's no option to carry forward anything or look for a refund. The rule also suggests that where withholding tax is not applicable, the minimum tax for the SEP or PE will be 4% of the revenue earned from Nigeria. So here's what we've covered so far. We've looked at the definition of non-residents, and we've said some companies that would have thought they are non-residents could very well be residents by 1st January 2026. We've looked at the type of non-residents that would get taxed with a particular focus on business profits anyway. We've looked at the expanded definitions of PEs and the force of attraction rules, and we've looked at the provisions around the attribution of profits to PEs. So we'll quickly be looking at a few more things here, including what has changed in relation to shipping and air transport businesses, double tax treaties, capital gains tax, control foreign companies, and how Nigeria is responding to Pillar 2. With regards to shipping and airline businesses, the main change, I would say, is the introduction of the EBIT approach to determining the profits of those entities. So the new rule suggests that where it's difficult to establish the profits that have been made by a non-resident company that operates ships and airlines in international traffic, there's the option to apply the EBIT ratio of the company as a whole to the revenue earned from Nigeria to determine the profits that will be taxable in Nigeria. Again, just like we have with the PEs and SEPs, these companies are clearly companies that are very asset intensive and typically have a lot of debts and leverage in their capital structure. And this approach effectively denies them the opportunity to get a deduction for the interest that they could have accrued for the purpose of their business. The minimum tax rule still stays. It's 2% of gross revenues. However, there's a new rule where you're required to file returns monthly. In practice, this is something that most of these companies already do, because a lot of them require evidence of filed returns and taxes paid to be able to get their monies out of Nigeria. But what we have now is that this rule has now been put into the tax law. So just like I mentioned, the key change here is the use of EBIT percentage as a basis to tax non-residents operating airlines or ships in international traffic. Another important change in relation to how double tax treaties will be applied is the law specifically states that for a non-resident to get the benefit of a treaty, it has to be a resident of the treaty country, and it has to be the beneficial owner of the income in respect of which that treaty benefit is being sought. And what this tries to do is to prevent a situation or counter treaty shopping. So it's a situation where in order to leverage or get the advantage of a treaty, a company that is not resident in a treaty country passes its transactions through another company that is in a treaty country and then obtains that treaty benefit. In reality, a lot of the treaties that we have already have beneficial ownership rules, but we are just seeing this being introduced specifically into the legislation. And what this suggests is that going forward, there's likely to be a lot more scrutiny around beneficial ownership when the tax authorities examine treaty relief applications. The other important thing that comes out of the regulations is in relation to chargeable gains or capital gains tax. So it's no longer news that the CGT rates will now be 30%, and there's essentially no differentiation between your income tax rates and the rates of tax you pay when you make a capital gain. But some of the important points that come out of the laws are things to do with indirect transfers. And I'll elaborate on that very quickly using this illustration. In this illustration, you have ABC Nigeria, Nigerian Incorporated, ABC Mauritius, Incorporated in Mauritius, ABC Dubai, in Dubai. Now, if ABC Dubai, now ordinarily under the current law, you would only have a conversation around capital gains if the shares in ABC Nigeria are sold by ABC Mauritius. However, under the new law, even if the shares in Nigeria are not sold directly, but are sold indirectly through the disposal of ABC Mauritius, that becomes a taxable event for Nigerian tax purposes. So in this illustration, we have ABC Dubai selling its shares to XYZ USA, meaning ABC Nigeria now becomes a member of the XYZ USA group and is indirectly owned by XYZ USA. Under the new law, this is a taxable event and is deemed that a disposal has happened of the shares of ABC. And therefore, whatever income ABC Dubai has earned from XYZ USA regardless of the fact that the shares that were disposed directly were not disposed of a Nigerian company, that income becomes taxable and subject to capital gains. I also have another illustration here where, because of the definition of residence, you could have a situation where the disposal of shares in a non-resident company becomes taxable in Nigeria. So in this case, if you have ABC Mauritius registered in Mauritius but managed and controlled from Nigeria, you have a situation where, based on the definition of residence, ABC Mauritius is deemed to be a Nigerian company. And if the shares of ABC Mauritius are disposed, it's deemed that the shares of the Nigerian company have been disposed, and therefore that then becomes liable to tax in Nigeria. The last 2 points that I will touch on are around deemed dividend distributions for controlled foreign companies, as well as income inclusion, which is essentially Nigeria's response to the Pillar 2 initiatives. So what you find under this scenario is, if a Nigerian company has a subsidiary that is a non-resident, and the FRS considers that that subsidiary could have distributed dividends to the Nigerian company without any detriment to its business, then the FRS could actually deem a dividend distribution and deem that the Nigerian company has received the income and then subject that to income tax. With respect to the income inclusion rule, the rule is that where a Nigerian company has a non-resident as a subsidiary, and for some reason, the effective tax paid by that non-resident is below the 15% global minimum tax rate, the Nigerian tax authorities could actually look to apply a top-up tax. So they will deem an inclusion of the income of the non-resident subsidiary in the Nigerian business, and then look to apply tax that will ensure that the effective tax of that non-resident subsidiary goes up to 15%. So even though this is a response to Pillar 2, it's quite different from the actual Pillar 2 rules, because with Pillar 2, you're looking at the effective tax on a jurisdictional basis. So you're not focused on just one entity, but rather all the entities that a group may have in a particular country to determine whether or not that effective tax threshold has been crossed or not. Final point here is on non-residents and e-invoicing. So this is something that the Revenue Service has started, and they've released several notices to clearly state that they would expect non-residents to also be part of this process. So those were the key highlights we thought to share with you very quickly in this time that we have. And beyond that, the question is, what do you then do going forward? Like I mentioned, it's hard to go through the details of all the changes in this very short time. But what people really need to start to think about is taking a much closer look at how all the details of the regulations or laws affect them. And that can be from the perspective of an operating model review, a value chain model review, starting from your organizational structure, especially if you're a Nigerian-led multinational group. You're looking at your group structure, trying to figure out whether there could be companies in your group that used to be non-resident but technically now residents, and the implication of that. You're looking at your funding structure, debt capital structure. You're looking at your value chain in terms of your inputs, your processes, and even your people. You're having an overall look at your business to establish how the new tax laws affect each part of the business. And at the minimum, ensure that you will be able to comply when the laws take effect. and where there are opportunities to actually manage the potential cost of compliance, you also have the opportunity to review and evaluate that. Thank you. So at this point, we will take questions.
Thank you so much, Seun. That was very insightful. As you would imagine, taxation of non-residents is a very interesting area. And it's very nice to see that the changes in the Nigerian tax laws, one, sort of try to align with global tax principles, but also introduce, quite some interesting changes that non-residents need to be aware of in terms of how they now become tax exposed in Nigeria. That being said, Seun, while you were speaking, there were some questions that were coming through. And just going through the questions, it tells me that, people were engaged and really want to know more. So I'll start to read out some of the questions and hopefully we can get your views and insights. So one question that came through is, what category of services provided by non-residents will not be liable to tax in Nigeria in line with the new rules? What is the place of double tax treaties in the new rules, especially looking at the new introductions of PE expansion and force of attraction? Seun, over to you.
Okay, thanks for that, Emeka. So for the first question on categories of services that would not be subject to tax, we need to look at how the provisions are worded. And the law essentially says where payments are made by a Nigerian resident or the permanent establishment of a foreign company to a non-resident providing remote services, then that income will be subject to tax in Nigeria. So it does not look to restrict the scope of services. The condition is, has a payment been made? Was the payment made by a Nigerian resident or the permanent establishment of a foreign company? And if those conditions are met, then that income becomes liable to tax in Nigeria. There are a few exemptions, but those are relatively minute compared to the potential scope of application of those rules. So for example, it talks about exemptions in relation to payments to employees that are non-residents, for example. What is the role of double tax treaties? The double tax treaties will potentially moderate the impact of some of these rules, because the general rule is where there's a treaty, where there is income that is subject to tax in the jurisdiction of both treaty partners, then one has to look at the provisions of the double tax treaties to determine what will indeed be taxable. And where the double tax treaty does not permit taxation under those circumstances, then there would be no taxation. So where there's a double tax treaty that does not permit the taxation on the basis of just mere payments, then that would override the provision of the local laws. But what you'd also see is that the FRS and potentially now the Nigerian Revenue Service started this process of negotiating double tax treaties. And it could be very well that they are looking to see the extent to which those double tax treaties could be renegotiated to allow them to get the full application of the laws that they've recently introduced.
Thank you. Thank you so much, Seun. Very well answered. Another question that has come through is a question around information. So I'll just read it out. It says, I am not sure that the term similar is defined. Would product or service differentiation help here? And this question is with regard to force of attraction rules that can bring in similar activities to be attributable to the PE. So what exactly is similar?
Yeah, so unfortunately, the law does not elaborate on that, and it will have to be a question of facts and, where possible, judgments. So it typically be expected to interpret the term in the same way that you'd interpret it in normal usage. So potentially, those are areas where there could be disputes, conversations with the tax authorities. It's possible that there could be circulars that will be released to answer some of these questions. So I'm aware that there's work that is ongoing on various circulars to provide further clarifications on any issues that may not be completely clear from the acts.
Wonderful, wonderful, Seun. I mean, those, clarification will be needed, especially when you have new laws without precedent. Another question that has come through is a question that says, and I think it's quite technical, right? So it says, what happens if the treaty doesn't have beneficial ownership clauses? Considering that treaties override local law, and now your local law is saying only apply this treaty if there's beneficial ownership. But then the treaty gives sort of a more blanket allowance for enjoying the treaty benefits. How do you play that? Thank you.
Yeah, that's an interesting point. And it will really, so I do know that there are countries where by mere introduction of those rules in the local law, those become effective and potentially they could moderate the impacts of the treaties. In terms of how that would apply to Nigeria, there'll probably need to be a more detailed technical evaluation of that. But what I've seen, looking at most of the treaties that we have, is that there's actually a reference to beneficial ownership, which could then potentially make that point a moot point, because practically all the treaties that we have reference beneficial ownership when trying to discuss the benefits or reliefs that are available for various categories of income.
Again, very well said. Thanks, Seun. I think I'll probably take just two more because we're running out of time. So this question is kind of administrative in nature. So it's asking, for non-residents that intend to employ Nigerians remotely, right, to target customers that are outside Nigeria. Seun, you already walked us through that and said those companies would not be exposed to taxes in Nigeria. But the question is, do they still need to register for taxes in Nigeria?
Okay, so potentially, if they are not deemed to have a taxable presence in Nigeria, then my expectation would be that there won't be a requirement to do so. But one would probably just have to check the letter of the law to ensure that there isn't a provision that could potentially capture them. Because I do know that there's this push to get information on companies that have different levels of interaction with the Nigerian economy, regardless of whether or not they may actually be taxable.
Very clear, very clear. Now there is a question on the force of attraction. I think this force of attraction is attracting many people to ask a question. So the question is, do the force of attraction rules apply to passive income? And if not, how about rental income? And the rental, is there any thoughts as to whether it's a finance lease or an operating lease? How do all of these, passive income, finance lease income, and operating lease income. How do these interact with the force of attraction rules?
Yeah, so that's a good question, and it will probably be one of those that the precise technical answer would have to be worked out as we start to implement all of these things. Because what you find generally in terms of passive income is there is always a rule that if the passive income is attributable to the permanent establishment, then it should be deemed as part of the profits of a permanent establishment. So potentially, there is that risk that it could also apply under the circumstances. Because remember, especially when if you look at double tax treaties, for example, it would always provide rules for taxing passive income. But it would then also say to you that those rules would not apply if the passive income is related to a permanent establishment. Meaning where the passive income is earned through a permanent establishment, then the rules around business profits or the taxation of business profits would override the rules around passive income. So potentially we could have a similar situation play out under the circumstances. Then again, like I said, these are some of the questions where we will start to get more clarity and insights as we start to evaluate the laws a bit deeper and also start to apply them.
Again, well said. So I think that, with all of this, like you said, there are risks, there are opportunities, and it's left for further analysis to be able to ascertain, how to sort of apply them going forward. There will be opportunities to send your questions through, as you would imagine. We will not be able to take all the questions on this call. So on that note, thank you so much, everyone. It's been an interactive session, as you would imagine. So I'll hand over at this point to a series. A series is going to talk us through our training programs upcoming and how we can get value from them. Over to you, Siri, if you're ready. Thank you so much.
Emeka, Chime, and Seun, I mean, this was very insightful even for me, and I'm sure for everyone that was on the call. And you can definitely see the reaction from everyone in the room. So we know that this period was really short to comb through all of the rules. And so there is a training session that's been organized that follows closely after this. And there are 2 modules, one of which will start in July, right up through August. And it's being held locally. It's also a hybrid session. The claps are not even allowing me see the text on the screen. It's from policy to practice and adapting to Nigeria's new landscape. And you'd see there are general sessions and also deep dive sessions that go into granular detail on some of what Seun and Emeka have shared. And then in the second module, we have this happening in November. So we give some time for break because we know there's going to be a lot of summer holidays. This is happening in Kenya, and it's really very strategic. It's reframing tax and navigating Nigeria's tax reforms amid global trade developments. So a lot more around what you need to do from a strategic standpoint, a governance standpoint, but also looking at the processes, the people, and the change management that's required to complement some of these changes we're seeing in the tax laws. The links for registration have been posted in the chat room. You can also scan the QR code that's displaying on the screen so that you start registering, and seats are filling up fast as well. So thank you. And I don't know, Emeka, would you then just round up, say the closing prayer, if there's anything like that? Thank you.
Thank you. Thanks, Asiri. Yeah, on that note, like Asiri said, the links for registering for the trainings have been put on the chat box. So please click them and register duly. Thank you so much once again. It's been a pleasure broadcasting live from our PwC studios to you. Ensure that you also participate in our upcoming webinars. Enjoy the rest of your day. Thank you.